All right, let's get right into it. For, most of history, tax has been a pretty physical thing. It was all about land and goods and stacks of paper trails. But the economy, it's gone digital. And now, tax authorities are in this frantic race to catch up. What we're really looking at today is a quiet revolution. It's a fundamental rewiring of how governments collect money, and in the process, it's changing the very relationship between the state and all of us.
And that really is the central question, isn't it? How do you apply these centuries-old tax ideas to an economy that you can't touch, that has no borders, and that moves at the speed of light? I mean, really, how do you tax a Netflix subscription, or a movie you stream, or the income from a million tiny little online shops that basically just exist as data? It's like trying to tax a ghost.
So this is it. This is the core of the problem. And it's also the core of the solution. The whole world of public finance is shifting. We're moving away from a world of physical things and manual ledgers to one of these integrated, real-time digital ecosystems. You could say the front line of tax collection has moved from the customs house to the server farm.
And the stakes here, they're absolutely enormous. Get this, 61 billion euros. That was the VAT gap in the European Union in just 1 year. That's the difference between the tax money they expected to get and what they actually got. It's just a massive hole, right? Created by fraud, evasion, and broken systems. And it's a hole that governments are betting big that technology can plug.
Okay, so where do they even start? Well, for a lot of countries, the very first step is to look inward. They've got to overhaul the engine of government finance itself. They basically need to build a digital brain that's capable of processing this new world of data. And that brain has a name. It's called an IFMIS. You should think of it as the government's central nervous system. It's this whole suite of software that automates everything, from creating a budget all the way to making the final payment. The whole point is to create a single version of the truth for every single dollar of public money. But this leads to a huge strategic choice. Do you build this critical system yourself, or do you buy it off the shelf from some global tech giant? And that's the fundamental trade-off, right here. It's the classic build versus buy dilemma. Buying a commercial system promises you speed, it promises standardization. But the cost? You get locked in with that vendor, and you're paying these massive licensing fees forever. On the other hand, building it yourself gives you total control. You can tailor it exactly to your needs, but you're risking huge delays, and you've got to have some serious local talent to pull it off. Now, if you want a fantastic case for the build approach, you have to look at Rwanda. They decided to reject the standard commercial route, and they built their own system called SmartFMS. They built it from the ground up based on the local accounting principles that their own staff actually understood. And the result? A system that gives them complete sovereign control, they avoid those huge licensing fees, and it's now used by over 12,000 public servants in more than 4,000 government agencies. It's a huge success story.
But here's the twist. Just installing a shiny new piece of technology, that's not a magic bullet. Not at all. In fact, if you're not careful, digitizing a broken process just means you fail faster and more efficiently. Sometimes, the new system can actually be turned into a weapon.
And this is exactly what happened in Malawi's infamous Cashgate scandal. Corrupt officials used their brand new IFMS to steal $32 million in just 6 months. The method was, frankly, shockingly simple. They'd just enter a fake payment into the system, print a real check, and then, once the money was cashed and gone, they'd use their admin privileges to just delete the original transaction from the digital record. Poof. It was like it never even happened. And this is the crucial point. The forensic audit found that the software itself wasn't technically hacked. The system worked fine. The failure was human. It was all about weak password controls, people sharing their login details, and just a total breakdown in basic checks and balances. The technology was perfectly sound, but the human systems wrapped around it were completely broken.
So while governments are busy trying to fix their own internal systems, they're facing an even bigger challenge on the outside. How do you actually collect money from that borderless, global digital marketplace we were talking about earlier?
Well, the Philippines has come up with a really clever two-pronged strategy. It's designed to target both the global tech giants and the thousands of local online sellers at the same time. Here's how it works. For the big foreign companies like Netflix or Spotify that are selling services to people in the Philippines, they've slapped on a 12% value-added tax. Simple enough. But for the thousands of small, local merchants selling stuff on big platforms like Lazada, they did something even smarter. They've made the e-commerce platforms themselves into withholding agents. So now, Lazada has to deduct a 1% tax from every sale a merchant makes and send it straight to the government. They've basically turned the platforms into deputy tax collectors. It's brilliant.
Now,
Let's jump over to Africa, because in Kenya, the mobile money system M-Pesa has been a total game changer. Look at this. It has brought over 75% of the population into the formal financial system. In doing so, it's created this incredible digital data trail for a huge, previously invisible informal economy.
So of course, the Kenya Revenue Authority is now trying to tap into that data trail. First, they made it super easy to pay your taxes directly through M-Pesa. Now, they're trying to treat mobile business transactions like a virtual cash register, capturing all that data in real time. And here's the most controversial part. They are actively trying to get broad access to all mobile money data to hunt for tax evaders by comparing what people are spending with what they're declaring as income.
And this, of course, brings us to a huge question. The tax authorities' push for this data, without a warrant, has run headfirst into Kenya's constitutional right to privacy and its data protection laws. This is really the central dilemma of this entire digital tax era. How do you balance the state's very real need for revenue with a citizen's fundamental right to privacy?
So where is all of this heading? Well, it all leads to the final stage of this transformation. What is really the ultimate goal for tax authorities everywhere? A world where tax collection is instant, automatic, and, if you're a compliant taxpayer, almost entirely invisible. This timeline kind of shows the whole journey. We started by filing paper tax returns months after the year ended, which gave fraudsters this massive head start. Now we're in the present, where more and more countries are demanding real-time electronic invoicing. That means the government sees the transaction the second it happens. In the future, that's AI that doesn't just record transactions, but actually predicts them and flags anything weird instantly.
So you might be wondering, does this real-time stuff actually work? Oh yeah, big time. Just look at Italy. Their VAT gap shrank by over 10% in a single year after they mandated real-time e-invoicing. It makes a common type of fraud, called missing trader fraud, almost impossible to pull off.
And this brings us to the end game, what we call invisible taxation. It's a system where your tax is calculated and paid the very moment a transaction happens, because it's deeply embedded into the payment systems and platforms we use every single day. For a normal, compliant person or business, the whole act of filing your taxes could eventually just disappear.
But this incredible efficiency leaves us with one last and, I think, really crucial question. When the friction, the pain of paying taxes is removed, when the system becomes so seamless that we don't even notice it's happening, what happens to that historic link between taxation and representation? As tax becomes invisible, will we demand more accountability from our governments for how they spend our money? Or will we start to demand less?